Hi to IPO subscribers. I'm Kotte Murali Krishnan, a chartered accountant by profession, and I'm SEBI approved research analyst. As we don't have the system of classifying and categorizing the companies into healthy, unhealthy, or defaulting companies, and network error companies also. So SEBI has been allowing all these companies to access public issue. Who is paying the cost of this absence of classification of companies? It is the investors who are paying who have been paying the cost. So that is the reason why we have started a software that prepares a comprehensive analysis report and categorizes the companies into healthy, unhealthy, defaulting, network error companies. I am being a professional. My sincere advice to your people is that invest only in healthy company and safeguard your hard-earned money. Today, let us analyze IPO review, a main board of IPO from Harijan Industrial Parks Limited. Here we got IPO review. As I told you, here is the comprehensive analysis of the report and it classified as an unhealthy company. Let us see why AA Port Software has classified this company as an unhealthy company. What are the financial weaknesses that made the company unhealthy company? First, we see the health analysis. And the health analysis, solvency. Solvency ensures the sustainability of the company. Here, debt equity ratio is okay. DSR is 1.16. It should be, in general, more than 1.5. So it is 1.16. And our interest coverage is only 0.63. That is other reason why the solvency is the negative. And coming to liquidity is okay. Strong, very strong, good, very strong. And coming to operational efficiency, all are positive except working capital turnover. It is only 0.38. How it is, I don't understand. So coming to your financial irregularities, so happy. So profitability, EBITDA is 607.8 and EBIT is 341.7, PBT is minus 197.29. So there's a loss, which is a loss-making company. PAT minus 203.65. Cash profits 62.45. EPS is minus 1.18. How this company came for public issue, I don't understand. And EBITDA margin is 79.15. Net profit margin is minus 29.45. ROC is a minus 4.23, ROE is a minus 4.23, and book value per share is 23.12. So finally, this company is a loss-making company. And coming to cash flows, cash flow from operating activities is 464.07, net cash flow is 229.38 crores. So market value, 60 rupees is the cap price of the IPO, and based on the 60 rupees cap price, price earning ratio is coming to minus 50.84. There is no meaning for price earning ratio. And price to book value is 2.59. Coming to growth indicators, 2 are negative, 3 are negative, only 2 are positive. So this is the AI financial analysis of Harijan Industrial Parks Limited. Now let us go for the IPO review. Here is the IPO review. India's largest industrial and logistic infrastructure platform is coming with 2,600 crore IPO. But here is the big question. Is the valuation attractive when the company is still reporting losses? Harijan Industrial Park has fixed IPO price band at 57.60 rupees per share with the issue opening on 17th, 2026. Right. Business overview. Harijan Industrial Park is a major industrial and logistic infrastructure platform. Key highlights, 45 assets, presence across 10 major industrial and consumption hubs, approximately 58.5 million square feet network, warehouses, fulfillment centers, and industrial facilities, expanding into in-city logistics centers, benefits from India's growing e-commerce and quick commerce, position to benefit from manufacturing growth in EVs, automobile, semiconductors, and renewable energy, long-term shift from unorganized warehouses towards great gear logistic infrastructure. As of May 2026, the company had about 28.55 million square feet operational network with 93.56 committed occupants, providing some visibility to future operating performance. Where is the money going? The company is raising 2,600 crores entirely through a fresh issue. But the most important point is this 2,250 crore debt repayment. This means roughly 86% of the IPO proceeds will be used to reduce debt. The company has borrowings of approximately 6,884 crores as of 31st March 2026. Positive, lower debt could reduce finance cost and improve profitability. What is the concern? A large portion of IPO money is going towards the balance sheet rather than directly funding expansion. So interest saving will be there, and whatever the net of tax is there, that will be additional profit for the company. And coming to valuation, the key investor question, PB 2.15 at the IPO price. The company is valued at around 2.15 times book value based on the figures provided. But there is a major problem. EPS 1.18 minus PE not meaningful. Why? Because the company is loss making. The company reported consolidated loss of approximately financial year 24 162 crores, 25 179 crores, and 26 204 crores. How this company can have valuation, I don't understand. So investors cannot use a conventional PE multiple to justify the IPO valuation. Our valuation view, 2.51 price to book value does not look extremely expensive, but the valuation is not compelling enough given the company's continuing losses. The real valuation trigger will be debt reduction, lower finance cost, lower losses, positive NO. Until that happens, the valuation deserves caution. Market sentiment. The IPO structure is heavily institution-oriented. QIB up to 75%, NIE up to 50%, retail up to 10%. Very good. Retail are saved. The market is likely to focus on institutional participation, debt reduction, and the company's ability to convert strong operating assets into sustainable profits. There are positives. The company has a large asset base, strong occupancy, and exposure to India's expanding logistics ecosystem. But sentiment is likely to remain cautious because the company continues to report losses despite strong revenue growth. Recent report note financial year 26 revenue of about 691 crore up to 77.1%, while the company will report 203.6 crores at net loss. Market sentiment, neutral to caution. Key risks. Persistent losses. The 3 consecutive years of losses create uncertainty around earnings visibility. High debt. The IPO itself highlights the company's need to deleverage. Finance cost. Interest expenses have been a major drag on profitability. Capital intensive business. Large investments are required to develop and expand the logistics infrastructure. Customer concentration. The top 10 customers accounted for 42.65% financial year 26 pro forma revenue, according to recent reporting. Final investor view. Business positive, financial health weak, valuation cautious, market sentiment neutral, cautious, and final view cautious, wait and watch. Arjan Industrial Park has an attractive business in a high growth logistics sector, but the current valuation needs to be supported by a clear path to profitability. The 2,250 crore debt repayment is a positive step, but until we see lower finance cost, narrowing losses, and sustainable profits, investors should remain cautious. Closing line. Good business, strong asset base, attractive industry. But at the current valuation, profitability is still the missing piece. As always, investment decision should be based on your own financial goals and risk tolerance. Thank you for watching. If you found this analysis useful, please like the video, subscribe to the channel, and stay connected for more detailed IPO and stock market research. Thank you. Thank you very much for watching the video.